All right, welcome everybody. I know that you're all hot, maybe out there, right? I hope you are keeping cool. And in order to help you keep cool, today we're having a presentation from somebody who's always cool, Ron Ricard, who's going to talk to you about how can you sell real estate and not have to pay a capital gains tax, right? That's one of the I would say sort of the general focus. So everybody come on in, find a seat, go ahead and take one of the middle ones, if that's all that's available. If you have questions as we're going along, type them in the chat. We're going to get to them at the end of the presentation. And if you want to get a copy of Ron's slides and presentation, then you'll need to send me $5. I'll give you the link. And well, no, maybe not. You would need to reach out to him, and you're going to find Ron's contact information also in the chat, as well as my information, in case for some reason you want to talk to me as well. Other than that, then, let's see. And yeah, one of the guys, he's down at the back. All right, so Ron, it's all up to you. Tell us a little bit about yourself and why you're here, and take it away.
Thank you very much, Mike. Thanks for the opportunity, and hopefully the people listening in get a chance to learn something here. My name is Ron Ricard. I work for a company called Investment Property Exchange, or IPX 1031. We are the nation's largest 1031 intermediary. Our job is to help you and your client do exchanges. I've been doing this more than 20 years, and look forward to giving you this presentation. It's going to take about 40 minutes tops. And then after that, we're open for a Q&A. If you want a copy of these slides, just let me know. Also, there's a lot of additional information that we're going to go over. If there's any specific information you want on any particular topic we're getting into, you are welcome to reach out to me, and I can get you that information as well. So with that, I want to go ahead and get started. We're going to go over the 1031 rules, the process, how you can use it to work with your clients. And then more importantly, we're also going to use it how to get more business out of it, because 1031 is a great tool. It allows you to do things that most times you can't do with other assets. So there's a lot of advantages there also. Anyway, let's get started. 1031 is a part of the tax code. It's the part of the tax code that allows you to sell investment real estate, buy replacement investment real estate, and in doing so, you get to defer paying taxes on the profit that you made. So what does that mean in English? You got a client with a rental house, been a rental for the last 20 years. They want to sell that and buy a duplex. So you list the property. At the close of escrow, the money comes to a third party called the intermediary. That's what we are. You then help them find that duplex they want to go buy. We send the money to the escrow on that side. So you sold something, you sold a piece of investment real estate, you bought a piece of investment real estate, and because you didn't touch the money, because we had it, you get to defer paying taxes on the profit that you've made. Now, that's an important word here. Defer, not eliminate. So if you sell a rental house and exchange it for a duplex, and later you do another exchange and you sell the duplex and buy a fourplex, and now you're old and tired and cranky and say, the hell with real estate, I'm just selling it. When you sell that fourplex, you are going to pay taxes from the house, the duplex, and the fourplex. You are just deferring paying those taxes. So a lot of times people will ask me at this point, well, why bother doing an exchange if I'm going to have to pay the taxes anyway? Well, there are two reasons we always encourage our clients to do an exchange. Number one, you want to pay your taxes today or tomorrow. For most of us, the answer is tomorrow. The way I look at it, if I make $300,000 of profit on something, and I got to pay $100,000 of that to the government in taxes, I only got $200 left. But because you get to do the exchange, that $100,000 that you're not giving the government yet, you get to use that to buy more real estate. It's a little bit like getting an interest-free, no-payment loan from the government. But the real reason you do the exchange is that hopefully you never have to pay the taxes. Because sadly, one day we're all going to die. And when you die, you win. Well, be honest. When you die, your kids win. Because when you die, your heirs get what's called the step up in tax basis. Now, make sure everyone understands this. I bought a property many years ago for $100,000. Today, it's worth $1 million. If I sell it, I have a $900,000 gain in that property. But the day I die, whoever inherits the property, their basis is the value of the property the day I die. And if your kids are like mine, the day after my funeral, they're selling all my real estate. So when they sell it for $1 million, how much capital gain do they have? Zero. It's worth $1 million when I die. That becomes their basis. It's like they bought the property at $1 million. So if they sell it for the same $1 million, then they have no capital gain in the property. And therefore, all the taxes that you would have paid all disappear when you die. Now, one thing to note is this does not work if you're going to give the property to your kids. This only works if they inherit the property. So you don't. So as a rule, it's usually a bad idea to give real estate to the kids before you pass away. But ultimately, that's the beauty of the 1031 is hopefully you never have to pay the taxes. Now, there's a term you hear a lot in 1031. That term is like kind, and this is a very misleading term, but it's actually very simple. Any business or investment real estate can be exchanged with any other business or investment real estate anywhere in the country. So you can sell a rental house and buy a commercial building. You can sell farmland and buy an apartment building. You can even sell bare land and buy a rental condo or an office building or a shopping center. Again, any kind of investment real estate for any other kind of investment real estate anywhere in the country. Give you a little bit of history. That term like kind goes back a few years ago, because many years ago, we used to do exchanges on things other than real estate. In my career, I've done exchanges for people's airplanes, people's artwork, farm equipment, cows. I mean, that's, that their like kind meant something. If you sell a farm, if you sell farm equipment, you have to buy farm equipment. If you sell a boat, you have to buy a boat. If you sell a piece of art, you have to buy a piece of art. That's what like kind referred to in terms of personal property. As of 2017, though, almost 5 years ago, Congress completely eliminated 1031 exchanges for everything except real estate. So now 1031 is only about real estate, and that term like kind is kind of meaningless now, to be honest with you. Now, when I said, though, it has to be like kind, I did say it has to be investment real estate. So what kind of real estate is not investment? Well, your primary residence. Your primary residence has a gain, has an automatic trigger in there. If you've lived in the property at least 2 years, you get to keep an automatic exemption. If you're single, you get to keep $250,000 of a gain tax-free. If you're married, you get to keep $500,000 of the gain tax-free. Now, there are certain parts of the country, such as the Bay Area where I live and Mike lives, where $500,000 of capital gain in a property is not enough. Now, when that rule was put in back in 1997, yeah, that was a lot of money, but not anymore. Now, when you sell your primary residence, a lot of times people have gain well in excess of that exemption. But the problem is, if they sell the property as a primary residence, then they have to pay taxes on whatever that excess gain is. So do clients who do not want to pay taxes, do they have another option? And the answer is yes, they have a couple things they can do. Well, first off, is there any portion of the property that they are writing off as business or investment property? Do they have an ADU? Do they rent out the basement? You as real estate agents, you may have a home office. The key is, what do you show on the tax return? If you are showing a percentage of your property as rental, as far or home office, as far as the IRS is concerned, that percentage of your property today can qualify for investment real estate. So using the example in here, I got $1 million property. 80% of it is treated as my primary residence. 20% of it is treated as investment property. Now, when I sell the property, 20% of the sales price can go into the 1031 exchange, and the other 80%, you still get the full $250,000, $500,000 exclusion against. So there is a real advantage, again, as long as you've been showing the property that way on your tax return. Now, most of us, though, don't have a home office, at least that we declare on our taxes, nor do we rent out any parts of our house. Is there anything else we can do if we don't want to pay taxes? The answer is yes. Move out. Turn your house into a rental property. Now, after you've been renting out the house for a couple years, is that house now an investment? Yes. Is it still considered to be a primary residence? Yes, because it still meets the criteria of having lived in the property 2 of the last 5 years. The reason this is critical is because of this, you can actually take advantage of both tax rules at the same time. So let's say the property sells for $2 million and it's a married couple, they get to pocket 500, and then they could do an exchange on the remaining 1.5 million. So this is a great strategy for a lot of people. Note, it does not work for everybody. If you need the money from your house to go buy yourself a bigger, more expensive house to live in, it doesn't work. Also remember that when you sell the property, you have to go buy other investment real estate. It is not for you to go buy another primary residence. Lastly, you are not just reinvesting that excess profit. You are reinvesting everything less the exemption. I actually had a case a couple of years ago. The guy had bought a house for like $9 million and was selling it for $20 million. And he didn't want to pay taxes, rented it for a couple of years. Then when he sold it, he was a single guy. He only got to keep $250,000, and the other $19.75 million went into the 1031 exchange. So anyway, just want to let you know this does exist. It is a way for you to take advantage of both tax rules. And if you have a client who has a highly appreciated primary residence and they feel kind of stuck in that property because they don't want to pay taxes, this is a good solution. And I'm doing these a lot these days. All right. What other kinds of properties don't qualify for 1031? Well, second homes. Now, a property that is for you and your family's personal use is deemed to be a second home. It is not, I'm not talking about a vacation rental. If it's a vacation rental like a VRBO or Airbnb, there are rules on how a vacation rental does qualify. A second home does not. And most of you are thinking, well, it's okay, my clients don't have second homes. A lot of them do and don't even realize it. Best example is you got a property and you're letting your kids live in there. If you're letting your kids live in the property and they're not being treated like a regular tenant, including paying market rate rent, it's not investment real estate. If you got a family member living in your property, you got to treat them like a regular tenant. You got to collect rent. You got to show it on your tax return as a rental property. Flipping real estate, not investment real estate. Same thing with development. If you buy something, fix it up and sell it, or buy a piece of land, build on it and sell it, to the IRS, those are properties held for resale, not properties held for exchange, not for investment. So therefore, it does not qualify for the 1031 exchange. So as a rule, an investment property is real estate that you're getting rental income from, real estate that you are using to run a business, like your home office. Bare land is kind of the one outlier. It qualifies as investment real estate because it is considered to be held for appreciation, but land is the only one that fits in that category. I should also note that you cannot exchange into or out of any kind of REIT or partnership or syndication. The reason is these are not considered to be direct ownership of real estate. Those are considered to be ownership in an entity that owns real estate. That is not direct ownership of real estate. All right, hopefully you all got an idea here. Again, any kind of investment real estate for any other kind. So I know there are probably a few newer agents in here. Some of you may have never been involved in a 1031 exchange. And all of a sudden, one day someone comes to you and says, hey, I want to do a 1031 exchange. Here are my first words of wisdom to you. Don't panic. There is very little involved for you if your client wants to do an exchange. You have the same listing agreement, same purchase contract, same MLS, same tour, same title company. Everything is exactly the same. There are only 3 little tiny things that I want you to do extra if your client is going to do an exchange. Number one, please make sure the client understands the rules. Now, one thing I want to emphasize right now, you as real estate agents, you are never expected to become experts in 1031 exchanges. That is not your job. Just like you do not know everything about termites or staging or escrow or loans, that's not your job. Do not feel that you have to become experts in 1031. The main thing I want you to be able to do today when you're done with this talk is understand a little bit about what exchanges are and how, and by recognizing those opportunities, let me help you help your client. I have brochures you can give the clients. I have it in multiple languages. You can have the client call me. You can have me call the client. If you're rather new to 1031, I think a great way to educate the client is to schedule a conference call. That way, not only do you know your client got his questions answered, but you listened in also. And so anything that we can do to help the client understand what the rules are. I am happy to talk to your client even before you take the listing. Okay, my job is to get people educated about exchanges. So please make sure the client knows what the rules are before they go too far. Number two is you do need to put something in the contract. It's often referred to as the cooperation clause. In the CAR contract, there's also something called the seller's intent to exchange addendum. But the key here is it is a disclosure. It is not a contingency. It has no effect on the buyer. The fact that your seller is doing an exchange, the only thing that happens is our name shows up on their closing statement. It does not delay anything, does not cost them anything. So the key here is that you do need to disclose it to them that your seller is doing an exchange. So educate the seller, disclose it to the buyer. And number three, please remember to call me before escrow closes. Because if escrow closes and you do not have the intermediary involved, then you get your money back, you pay your taxes. We have to be involved before escrow closes so that the title company knows that at the close, the funds come to the intermediary, not to the seller. Otherwise, everything else about your listing, everything else about you selling this property is exactly like any other transaction. All right, now the client has sold his property, we got the money, you got your commission check, everyone's happy. Now the client has to go find replacement property. There are two important rules to know if your client's going to find replacement property. First one is from the day escrow closes, they got 45 days to identify, to tell us what they're going to buy, and 180 days to actually buy it. 45 days to give us the exact address to the property they are purchasing, 180 days to close escrow. Now, what does identify mean? Identify means you fill out the form that we send you that allows you to write down a specific number of properties. Most people are only going to buy one or two properties. They can identify up to 3, but you have to buy from that list. Now, during the 45 days, you can change your mind as much as you want, but once you get to that 45-day clock, then whatever you've identified, you are locked into. For practical purposes, you should plan to be in contract on your property by that 45 days. So again, 45 days to identify what you're going to buy, 180 days to close. Now, a couple of things about the 45 days I'll point out. First one is, remember that the 45-day clock starts at the close of escrow. So if your seller is very worried about not finding a property within the 45 days, one thing you can do to help them out is to ask for a longer escrow. 45 days, 60 days. I've seen 90-day escrows. I just got one earlier this week. The guy the buyer is literally giving the seller until the end of this year to find a replacement property. Now, mind you, that's a long time. Whether or not the seller's going to take that long, who knows? Hopefully not. But again, it's whatever you can negotiate with the buyer. I would not recommend it being open-ended because the buyer could easily walk away if they get tired of waiting. But the longer before escrow closes, the longer before the clock starts. The other thing I do want to point out is there is something called a reverse exchange where you actually buy your property before you sell yours. I'm not going to get into it in detail. It is a much more expensive and complicated transaction, but know that it does exist. The key is we have to be involved before they buy that property. Because if they buy that property, they now own both of them. You can't do an exchange into something that you already own. So we have to be involved before they buy that property. But just know a reverse exchange does exist. If you have a situation where you think your seller is going to have to do that, then get me involved and we'll go through the client's individual situation. Again, it's not for everybody, but it does exist. All right. Now, when we talk about identification rules, there are different rules for identifying. So if your client does want to buy more than 3 properties, there are ways to identify more than 3. I'm not going to get into these in detail. Again, the key, what you want to focus on, if to the degree possible, be in contract by that 45 days. All right, next part that's very important is how much you need to reinvest when you're doing an exchange. And I will say that probably half of the people I talk to who've never been involved in a 1031 get this wrong. So it's very simple though. How much you need to reinvest? All of it, equal or greater to what you sell the property for. Not the equity, not the profit, everything. So if you sell the property for $1 million, you need to go buy for at least $1 million. Now, can you buy for more than $1 million? Absolutely. Can you buy 2 or 3 or 10 properties that add up to $1 million? Absolutely. Can you buy for less than $1 million? The answer is actually yes, but you pay tax on the difference. Some of you may remember this from your real estate exam. It's called boot. Boot is what you pay tax on. As a rule, though, if your client does not want boot, they want to buy property equal or greater in value. So it's what you sell the property for. Part 2, all of the cash, all of the equity that comes from the sale, all has to go as a down payment on the new property. Any cash left over is taxable. Now, I know interest rates have just changed a lot, but up until very recently, we had a lot of clients wanting to maximize their loan because of low interest rates. The problem is sometimes people were getting too big of a loan. And if they had too big of a loan, even though they're buying something more expensive, if you get too big of a loan, you're going to have cash left over. You have cash left over, you're paying taxes on that leftover cash. So it's important that you match the loan with the equity in the exchange. Now, obviously, if there was a loan on the property, that loan is going to get paid off. But to satisfy the exchange, you have to replace the value of that loan, either with another loan or with cash from your pocket. But you need to replace the value of that debt. Obviously, what we're getting here is any money you touch, anything that comes back to you, you pay tax on. Real simple way to look at it. Did you buy something equal or greater in value, and did you use all of the equity? As long as you have met those 2 rules, then you have deferred all of your taxes. Now, there are some common myths when it comes to exchanges. I'll touch upon a few of these. Now, believe it or not, 1031 exchanges used to be simultaneous. I mean, sometimes they were literally deed swaps. Mike had a duplex, I got a farm, we would swap properties. And that's how 1031s used to be about 100 years ago when it started. Not anymore. Now you sell to one person, you buy another. Similarly, 1031s used to be simultaneous. You had to sell and buy the same day. Not anymore. As of 1984, Congress amended the tax rules, giving us this 45 and 180-day rule. So they do not have to be simultaneous anymore. A lot of times people think 1031s are really expensive and very complex and only for really big commercial deals. Nope, it's really pretty simple. And there's just a little bit of paperwork to be done. I've done exchanges for $25,000 pieces of land before. It's really not a complicated or expensive transaction. There's also a common misconception among a lot of accountants that a property cannot be, you cannot do a 1031 exchange on a property if you also live there. And that is absolutely not true. And the simple example is a duplex. You live in one side, rent out the other. Obviously, that is a dual use property. There are many ways. The IRS has enumerated 6 different ways a property can be a dual use property. Lastly, a lot of people don't know that they need to use an intermediary. Anytime you do an exchange, you can't have your attorney or your friend hold the money or the money comes to you. We are a required part of every 1031 exchange. Now, for some of you who are a little more experienced in exchanges, I want to throw out what I call my red flags. These are very common problems or issues that will pop up when people are doing an exchange. First one is family. People want to buy and sell among family members. The problem is there is a limitation in the 1031 code with transactions done with related parties. And the way the IRS rule views this, essentially buying replacement property from a related party is almost impossible. So again, I don't expect you to remember this in detail. Just know this: if you have a client who wants to buy and sell property as part of an exchange with family members, please call me. Sometimes you can do it, sometimes you can't. Sometimes you can do it if you follow special rules, but you want to know what those rules are. Number two, seller financing. Seller financing, not too common in urban areas, but for commercial real estate and farmland, seller financing is very common. Seller financing and 1031s don't mix. Now, are there ways around it? Yes, but as a rule, anytime the seller is carrying a note, that will almost always become taxable. Vesting. This is a huge issue. In an exchange, it has to be the same taxpayer buying and selling. If Mike is selling, Mike has to buy the replacement. He can't sell and give the money to Lynn to buy the replacement property. It has to be the same taxpayer buying and selling. So where this becomes an issue is you want to make sure that the people on title are the ones doing the exchange. So please order a copy of the title report, look at it. Please make sure the people in front of you are who's on title of the property. Even adding a spouse is a problem. So if you bought the property when you were single and now you want to do an exchange and buy the replacement with your spouse, that can be a problem. So again, the key here is it does not need to be the exact same wording of taxpayers. So in other words, for example, if you sold your property in your trust, well, your trust is not a taxpayer. Your trust, everything goes onto your personal tax return from your trust. So you and your trust are the same taxpayer. So you can sell in the trust, buying in your own name or vice versa. That's fine, but it has to be that same taxpayer buying and selling. Foreign sellers, anybody who's potentially subject to FIRPTA. Please make sure that if the client is not a U.S. citizen or U.S. permanent resident, they may be subject to a withholding. If they are, that there's some additional paperwork they need to do. Sometimes that paperwork can take literally months to get back. So the reason I bring this to your attention is if you are dealing with a foreign seller, please make sure that both the 1031 exchange company as well as the title company are up to speed with them up as early as possible. So let them know early in the process that your seller is a foreigner, because again, there's extra paperwork to be done. Lastly, please make sure your clients don't just work with any fly-by-night intermediary. What we do, what our company, our industry does as an industry is not regulated. You want to make sure you're only working with very large companies with lots of bonding and insurance, like us. So the key here is you want to make sure you're working with big, safe companies, because we're holding millions of dollars of your client's money. You want to make sure it's safe. All right. So in essence, that is what an exchange is. It's really not complicated. You're selling investment real estate. You're buying investment real estate. You got to know what you're going to buy within a certain time window, and you got to reinvest all the money. Otherwise, not too complicated. So let's talk a little bit now about marketing. Why do people do 1031 exchanges? And the knee-jerk reaction to that is, well, it's just not pay taxes. And I would say that that is not correct. The easiest way to defer paying taxes is just don't sell the property. The reason people do exchanges is because they want to buy something better. Now, what does better mean? Better means whatever the hell the client wants it to mean. It could be that they want to sell one big building to buy lots of small building. Maybe they want to sell a lot of small buildings to buy one big building. Maybe they're moving to Tennessee, so they want to move all their rentals to Tennessee. Maybe, and this is a big one in today's market, they're looking for better cash flow. Because I know the market's finally started to slow down a little bit. In the last couple of years, much of the country, especially like in the Bay Area, the price of properties have gone up around 50% in most markets. But guess what? Rents have not gone up at all. And so because of that, you have a very highly appreciated asset with a very low return on that asset. So a lot of people are exchanging into properties that are going to generate better cash flow. Maybe they're going to look and they want to do an exchange into a property that ultimately they may want to move into themselves. Maybe they ran out of depreciation. A lot of older people, I'm going to get into this in more detail. A lot of older people, they are tired of managing real estate. So they are looking for something easier to manage. Another one is you can look at doing 1031 as an estate planning tool. A good example here, I just finished an exchange for a gentleman, 95 years old. He had this $6 million property and 3 daughters. Well, if you have any kids, you'll know that once he dies, his kids are going to fight over that property. And so instead, he didn't want them to fight. So what he did is he did an exchange for estate planning purposes. He sold his property, bought 3 properties. Now when he dies, each kid knows exactly what they're going to inherit. So that's a real advantage that way. So again, the key here, what I want you to think about here is when you're talking to investors, don't focus on deferring taxes. Focus on what is a better property for you tomorrow than you own today. What do you want out of your real estate? Because 1031 is the tool that allows you to get from what you own today to what you want to own tomorrow. And if you think about it, 1031 exchange is a really powerful tool because real estate is literally the only asset that you can sell at a profit and not have to pay the taxes. Stocks, bonds, art collection, anything that you sell at a profit, IRS is going to want a share of that gain, but not with real estate. As long as you're using that money to buy other investment real estate, you don't have to pay the tax man every time. That's a real beautiful thing to do. Now, I want to focus a little bit about properties easier to manage. When you're young, you're probably doing 1031 exchanges to build your real estate empire. As you get closer to retirement age, a lot of people are looking to exchange into assets that are going to generate better cash flow for them. But as you are retired, you're looking for things that are easier to manage, and you are looking specifically for what I call exit strategies. I'm tired of managing my rental property. What can I do to not have to manage this property? Well, there are a few things that you could always do. So if you got a client who's in this situation, they're tired of their rental property, what can they do? Well, they can always sell and pay the taxes. Dying is a great tax strategy, though I never recommend talking about it too overtly. Seller financing. Seller financing is a great tool if you are not doing an exchange. A good example here, my father. My father, when he retired, he looked at his rental property and says, I'm done. I want to travel. I want to do everything. And my father was a very hands-on, in fact, still is, very hands-on type of guy. And so when he died, he sold all of his properties, but he sold under seller financing. He acted as the bank. And so he got a little bit of money for 20 years from the seller. And by doing that, he only had to pay taxes over that 20-year span. So seller financing, if you are just cashing out, is a good tax strategy. Another thing a lot of people will do is they will do an exchange into a property that later they're going to move into. So you basically, my goal is to retire to Hawaii, so I'm going to do a 1031 exchange to a property in Hawaii, rent it for a few years, but when I retire, I know where I'm moving to. Another strategy. Again, we talked about estate planning. Another thing that a lot of people do is they go into assets that are low management. And the first one on there is a pretty simple one. It's called triple net or net lease commercial real estate. That's where you buy a McDonald's, you buy a Walgreens, you buy a Jiffy Lube, you buy a Starbucks. Now, note, you are not buying the business. You are buying the building and land. that they are in and you lease it to them. I've seen net lease properties for government, DMVs, post offices, for universities. The IRS building in Fresno was sold under a triple net lease. So again, here is you have very long-term leases, very predictable cash flow, and the tenant does all the work. The tenant pays all the taxes, all the maintenance, all the insurance. Refer to net lease or triple net commercial real estate. Now, a lot of us, though, don't have the millions of dollars needed to go buy a big piece of commercial real estate. So there are companies out there who will sell it to you in fractions. It used to be common under what's called a tenant in common. Now, most of them are structured under what's called a Delaware statutory trust. And Mike will probably want to weigh in on this in a little bit. But in a DST, what you have is companies out there who will buy a $50 million apartment building or major complex, and they'll sell it to you in fractions. So if it's a $50 million property and you want to buy 500,000 of it, you're buying 1% of it. Now you can buy, excuse me, you could buy a small fraction of a large piece of commercial real estate. And the advantage to them is that it's very low management, very predictable cash flow, and it qualifies for 1031 because you are still buying investment real estate. It's just that you're buying a fraction of that piece of investment real estate. Now, there are some negatives to it. It's not a very liquid asset, but I do see a lot of people in today's market going into DST. So just wanted to make sure you are aware they exist. Now, a lot of agents aren't happy with those because you may not get a commission if they buy a DST. However, I don't want you to think about it that way. What I want you to think about is you got a client who would not be selling their property if they don't have a way to save, and if they don't have a way to defer those taxes. So if they don't have an exit strategy, they ain't gonna sell. If they ain't gonna sell, you're not gonna get that commission on the selling side. So don't get too hung up about getting paid on both ends. Make sure that the client gets what they need out of the transaction. With that is my talk. I know that Mike has set up my, has given me my information on the chat box there, but I will stop doing the share now. And Mike, we can see what questions people have.
Cool. Thanks a lot. So Lynn says that the $5 for the slides is cheap, so we'll probably have to raise that. Appreciate those. Several people have asked for a copy of the presentation materials and the brochures. I repeatedly posted in Ron's contact information, so just reach out to him and he'll send them to you. We've got that a couple of times.
Actually, Mike, before you go there, let me ask a couple of things I should have ended with that I forgot to. Number one, I do want to say something I said at the beginning, and I really want to emphasize this. Do not feel ever that you have to become experts in 1031 exchanges, okay? Use me. I'm here to be a resource for you. Also, I do have a newsletter I put out once a month on 1031 exchanges and tax-related information. If you're interested in it, send me the email. I'll put you on that list. Again, it only comes out once a month. I'm not going to sell your information. It's only on 1031 and tax-related information. So if you're interested, please send me an email on that as well. Sorry about that, Mike.
Oh no, that's yes. We should be reluctant to give tax advice. How about that? As a real estate agent, we should be reluctant. I would say is an understatement. We have repeated requests for the presentation materials, which I hope we've covered. What if a property has a mortgage? Can that amount be eliminated and only what is in hand equity reinvested?
You can, but if you do, you're going to pay tax on that mortgage. It's referred to as mortgage boot. Because, let's use a simple example. You sell $1 million property that has a $400,000 mortgage. So you have 600 of equity. You sell for $1 million, you got to buy for $1 million. And so that $400,000 of debt that got paid off has to be replaced to defer those taxes, either with another loan or with your own cash. It is a very common misunderstanding with people that they only have to reinvest the equity. That's incorrect. That's wrong. You have to reinvest everything, including replacing the value of the loan.
All right. It's the difference, isn't it, between gain and equity, which is sometimes,
Well, don't confuse the gain and equity. Gain is what your profit is that you pay tax on. Equity is the cash coming out of it. I don't care about either one of them, equal or greater to the sales price of the property.
right. My point was, is that some people think equity means gain.
Right, and which they're not related at all. Please don't confuse them.
How do the taxes compute if you move into an exchange property?
That's a great question. So again, it's a common strategy people have to buy a property that later in the future they want to move into. Now, a couple of things here is the first question they will always ask you is, well, how long do I need to rent the property for? And again, do not answer that question because it is not an answer that you can give them because it is not something the IRS has ever given us. So you do not know the answer to that, and you do not want to give them tax and legal advice. Now, the reality is most accountants are going to recommend at least a couple years of having rented the property. Now, if sometime down the line they want to convert that property into their primary residence, there is no tax due when they move in. There is no tax due when you convert the property. However, there will be tax due when they sell the property. Because when you sell the property that was an investment or second home and then it gets converted to primary residence, you have to pay taxes on a proration of the capital gain based on how long you've lived there versus how long it was rented before you moved into the property. The takeaway here is, again, it's a fairly complicated calculation. I have a PDF about it if you want to read about it, but the converting the property in and of itself does not create a tax liability.
Okay. Monica asks about how to convert a 1031 exchange property into personal property. I'm not sure if she meant a personal residence, but
right. And I think I just answered that question. I mean, ultimately the answer is a moving truck, but
right.
Ultimately you're going to want to season the property long enough as an investment that there's no question that you would purchase the property as an investment real estate first.
Right. Beatrice wants to thank you that it was an outstanding webinar. Appreciate your time and information. I'm sure sentiment shared by all. This is Khalid, why are qualified intermediaries not regulated? How to protect oneself and the client when picking one? Well, that's easy, Khalid. You just need to call Ron.
Well, I'm going to go a step farther. I mean, actually, the truth is this. We went to the Consumer Protection Finance Bureau and asked them to regulate us. And they said, no, they had much bigger fish to fry than us. And they don't really, we're a small industry compared to all the other finance stuff. So it is kind of scary. Here's my suggestion. Stay with the sister companies to the title company, because they are the ones backed by very large corporations. We're backed by the same company that owns Chicago Title, not backed by, owned by the same company that owns Chicago Title and Fidelity Title and Lawyers Title. I work with everybody, but the key here is we're owned by a Fortune 500 multi-billion-dollar corporation with hundreds of millions of bonding of insurance. And, and most of the title companies can say that also they have very large parent corporations. And so that's where you want to stick with. Don't let your client look on the internet and find somebody who's $100 cheaper. Not worth the risk.
All right. Judith asks, do the property taxes go market value for property taxes from the time you make it a personal residence? She's asking, yeah.
When you're doing an exchange, you are resetting the property tax basis. Okay, so but investment real estate, like any asset you buy in California, whenever you buy it, property taxes are still under Prop 13, whether it's a rental or you live there. So moving into the property does not change your property tax basis.
The only way to keep an old property tax basis, and I have another video on my YouTube channel done by some attorneys about the transfer of property taxes, but that does not apply in this situation. It's talking about personal residences.
That's only for primary residences, yeah.
Yeah, if you sell Jonathan wants to know, if you sell a primary after turning it into a rental, you have to prorate the exclusion, correct?
No. The proration is only done for the years prior to you living in the property, not for the years afterwards. Also a very common misunderstanding. So if you have lived in the property for 20 years, move out for 2 years, you still get the full exemption. It's only if you've been renting the property first, then move into the property, that you need to do a proration.
And Khalid says that he's just going to use you, so he doesn't have to worry about who it is. Jeffrey says, thanks, Ron, great information. Paul, how is the 1031 exchange company paid? Roughly, what does this cost to the client utilizing their services approximately?
Yeah, and that's I'm glad you asked, because it's a nominal amount. It's $1,000 when the property is sold, and $250 for each additional property bought or sold as part of the same exchange. So $1,000 on the sale, $250 on the purchase.
That hasn't gone up because of supply chain issues and things like that.
Well, it's gone up a little bit because we did raise our rates a little bit, but nothing to do with supply chain. No.
Sounds like a deal. Monica wants to know if you work with Lynn Dang of Chicago Title, because you mentioned.
I love Lynn Dang, absolutely.
Well, we all love Lynn Dang, right? I think that's. And any other questions? Monica's happy that you work with Lynn because we all like Lynn. And I am not seeing any more. This is it. This is your last chance. Any burning, smoldering questions? And I think wait a second, great session. So I guess we've satisfied them because
Fantastic.
we warned them out or answered all their questions or done a little bit of both. All right.
Great.
So reach out to Ron. Can this exchange? Oh, one more question. Can this exchange be transferred to somebody else? Not sure.
I'm not sure what you mean by that. Again, the key in the 1031 is it does need to be the same taxpayer selling and buying. So you can't transfer the replacement property to another party as the buyer of that property. I'm not sure if that's not your question, call me afterwards, we'll talk about it.
Yeah. And Jonathan wants to know, if you're a real estate professional, can you do a 1031? If you're talking about your personal properties, yes. I'm not sure if you want to be an intermediary, I wouldn't advise it. Not sure.
Yeah, and actually, by definition, the intermediary cannot be anyone with whom the client has a financial relationship. So we cannot be the client's accountant or attorney or realtor or lender or title company. We are a neutral third party, cannot act in any other capacity.
All right. I had a difference which client owned three. I had a difficult, client owned 3 lots side by side. One was a rental, one was a primary residence, and one was only for horses. I guess the question is, this is about, they wanted to move out of state, but they felt that they would pay too much capital gain. Any advice on how to handle this? This is a question from Jessica.
Actually, that's kind of an interesting one. I mean, we'd have to talk a little bit more about it. My first suggestion would be, in discussing this with their tax professional, is there any way that you can say that a portion of the property is not primary residence? Is a portion of the property either like land, held for land purposes, or held for business purposes? You said something about a stable or something like that on there. So if there's a portion of the property that can be allocated to business use or investment use, then potentially a portion of the property could be viewed as investment there also. So a lot of it has to do with tax reporting. But yeah, there may be a way to do this.
Yeah, and I think from her question that they own 3, if these are 3 different legal parcels that just happen to be next to each other, then each one would be its own deal, right? Rather than one package.
Possibly, because I've also seen situations where people have 3 separate parcels, but their house covers all 3 parcels.
Right. Yeah, yes. 1 APN. Right. Yes. But 3 legal parcels.
Even 3 APNs. They have one house, or they have a house on one, the pool on the other, and the cabana on the third, or something where basically it's all still primary residence. In that case, it's still all primary residence. But yeah, again, there are ways to look at. I mean, there are what I always say is this: with enough planning, you can almost get anything done. So that's the key. Don't call me when you're in contract. Call me to plan.
Right. Anyhow, I think we've answered enough questions. If you've got more questions, deeper questions, reach out to Ron. He, as you might notice, is happy to talk about 1031 exchanges with people. All right. Thanks a lot, Ron. Really appreciate it. Good to see you. You know, it's been a while. Still not in person yet, but that's coming again soon, I'm sure.
I'm sure. Well, thanks for having me, Mike.
All right. Bye, Ron. Bye, everybody. Stay cool out there, everyone. Bye.